Hang Seng is a bit muted. Taiwan index also has opened up a bit muted in trade.
Growing at 5% year after year, that is something that will worry the Reserve Bank, whose mandate is to keep it at 4%.
So revenue growth on a year-on-year basis is down about 8%. EBITDA is down 12%.
Near-term resistance is 25,090, which is the 40-hourly exponential moving average.
Results were weak. The management called out the impact of quick commerce as well. And now to add to that, there have been a slew of downgrades.
Nifty is coming up with a gain of about 0.25%, 25,025.
But in the short term, given the results season, I expect also to be pretty bad.
Combined, we paid euros 127.5 million for this deal.
Next year, perhaps deficits will be larger and fiscal policy will still play a key role.
NCLT route is not going to be adopted as far as MTNL is concerned. As I just mentioned, it has to be kept alive as a going concern.
Today, Monday morning, the Nifty's zoomed past its 50-day moving average.
So 1.84% is where the WPI data has come in.
So far, it's been a decent Monday morning for the bulls. Mid-cap has also recovered from the lows.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good afternoon. You're with us here on a fresh new edition of Closing Bell. We are coming to you live from the CNBC-TV18 Motilal Oswal studios, and is looking good across the board. The markets are up 150 points in the Nifty, and broader markets have also picked up quite a bit. I'm Prashant. With me, my colleague Surabhi and Rima in the studios, and Nigel is joining us from the newsroom. Guys, hi, good afternoon.
Hi, afternoon. Good to see the banks outperforming once again. That's been the pillar of strength.
No, absolutely. And, I think it's... that index is up about, I think, 1.25%. Actually, it's broader markets which have picked up as well, from starting 150 or so, sharp surge in the mid-cap index. But I still think, as I was walking in, market breadth is slightly maybe in the negative. So for a market which is up this much, it's not as if the broader market is roaring. There you go, on your screen. That's the advanced decline ratio. Just a couple of points. Nifty is trading finally, after 2 or 3 days of trying and failing, is finally above the 40-hourly exponential. So next is essentially the swing high we saw 3 days back, which is 25,235. Let's see if we are able to go there. That's a neat 100 points from where we are right now. Bank Nifty is nearing the first resistance, which is 38% of retracement of the fall, which is 51,826. I don't think we got to it, but just, I think, 50-60 points away, basically, from where we are right now in the Nifty Bank. But that's the first one. Then you look at the 50 and then the 61.8. Sharp surge in mid-cap index starting 150. And if you want to look at sectors, real estate, IT, and of course, private banks, which is showing up in the Nifty Bank. These are the three indices which have got gains in excess of 1% on your screen. So those are pockets of strength. Rima.
Well, in IT names, it's Wipro top of the charts with a 4% gain. On Thursday, it's results plus a bonus issue. Following that is Tech Mahindra, HCL Tech, which reports numbers later this evening, along with Reliance Industries. HCL Tech is up 1%. TCS, though, which disappointed the street last week, is not participating in the IT rally, so TCS is absolutely flat. In the banking pack, it's HDFC Bank. That's up nearly 2%. ITC is looking up. And let's pull up Reliance Industries ahead of numbers. Remember, Reliance Industries over the last month or so, or about fortnight, has fallen from levels of 3,050. It's been a bit subdued. And today as well, there is no big excitement going into the numbers. So that's, absolutely flat in trade. But so much happening in the broader markets, right? You've got IEX, you've got Dmart, BSE continues to surge.
Yeah, absolutely. Lots of movers and shakers in the broader markets. Just want to point out on the global screens, though there was no clear weekend announcement from China, the mainland market has still closed with a 2% gain. So it's very clear that the optimism surrounding this expected move is still very much intact. There's some profit taking in the Hong Kong market. There you go, Hong Kong was down. But the mainland Chinese market has managed to close positive. And, we had more data come out of China, the export-import data, and it was fairly weak. So it's reinforcing the expectation that they will move for sure. It's a question of when and not if. So that's on the global arena. And, we've got European markets trading pretty flat. No clear trends, flip-flopping between red and green. So that's the global picture. By the way, before I talk about mid caps, L&T is the other very interesting mover. Yeah, that's the French market for you. So Europe is, mildly negative to positive, range of 0.1, 0.2% on either side of the screen. L&T is a very interesting stock as well because JP Morgan has an overweight rating and they're very bullish on the stock. Their target is northwards of 4,000 and they're saying that the company can deliver around 23-24% sustained growth for the next couple of years, and it's offering very attractive valuations right now, the stock. So that's worked well. That's a call on L&T. And I remember Prakash Diwan in our morning call also said that L&T is the way he'll play the whole infrastructure story. So that's one heavyweight that's standing out. But other than that, like Rima pointed out, mid-caps not having a bad session. There was a bit of red, but it got bought into. And at an individual stock level, there's plenty of action to keep us busy. And we'll talk about that as we go forward. Nigel, what are you looking at?
Well, when your top batsman is in top form, that's what helps you score a higher amount of runs, right? And that's what's happened today. HDFC Bank is showing signs that, it's getting bought into. Last week as well, periodically there was some buying being seen on private sector banks and HDFC Bank in particular. And today as well it's doing well. Now, if you just pull up a chart, HDFC Bank with the 20 and the 50 DMA, it's conquered the 50 DMA. The 20 DMA comes in at around the 1700 rupee odd mark. So it needs to get past that mark, to give it further legs. It's very, very close to that mark. You want HDFC Bank to get past the 1700 rupee mark and then move up from there. So that's about HDFC Bank because that's a leader today. The other one I just want to focus on is the IT space. On the day TCS reported weak numbers, I recall me and Rima were chatting in the studio that the numbers were weak, but it could be a company-specific thing with regard to TCS. But the index saw a bit of a dip just for the first, 1 hour or so, and that dip got bought into. You have Infosys that's on the verge of making a fresh 52-week high, and we had made this point that, the street wasn't buying it for Q2 numbers. They're buying it for visibility with regard to FY26. And you've seen a big recovery on all these names. Wipro obviously is the outperformer. And finally, on the mid-cap index, intraday we saw a spurt. Today is one of the last few, weekly expiries that we're seeing on the mid-cap index. In the next month or so, we'll only have the Nifty that will be having weekly contracts. But for now, you have the mid-cap index as well that has a weekly expiry. So that could be another reason why intraday suddenly we saw a big spurt on that counter. So that could be one of the probable reasons. Well, Mitesh Thakkar is back with us to help us out with a call on the index. Mitesh, you can't, fall this session today. Very, very good move is what we're seeing on the Nifty. But the more impressive move has come in on the Nifty Bank. Last 3 sessions, it went to 51,600, 51,700, and then it saw a U-turn. Today, it's conquered that. Your reading.
So, good afternoon, Nigel. I would agree with that. Between the two indices, also the chart of the Nifty Bank is looking more interesting. And now that it's trading above this 51,600 zone, I think 51,640 could be a good stop loss for taking long positions, or if you have long positions trail to that level. And on the upside, there's a good chance that the bank Nifty might hit 52,350 to about 52,700 as well. So these are the two levels on the upside I'm watching. So yes, in that sense, I think the banks are doing well. On the stock side, I have a buy on HDFC Life with the stock at about 727 for targets of 770. And HCL Tech, in fact, both these stocks have numbers today. HCL Tech is breaking into a fresh swing high, so we'll take a very tight stop at 1844 and a target of 1895 can be looked at.
Thank you very much for that. Let's get to the stock of the day, and that's undoubtedly Avenue Supermart's weak set of numbers. The street is disappointed. Earnings are being cut. Downgrades are coming through as the company battles the onslaught of competition from QSRs. Mangalam joins in to tell us more. Mangalam.
Well, it's been a weak performance for Dmart, but what's hurt the street a lot more is the commentary from the management, them formally acknowledging that there is, some sort of pressure coming in on account of the online retail platforms, especially in the metros itself. So if you just take a look at the, performance of the company, it seems like it's the beginning of a structural decline in the marginal profile. Why do I say that? In the margin profile. Why do I say that? Because on the one hand, you have competition coming in from online grocery formats. On the second, the company will be investing on increasing their store footprint and increasing the Dmart Ready business as well. And the third part is that the, sales mix has tilted more towards essentials as against non-essentials, which again were margin accretive. So all these factors point to some sort of margin structural decline in margins itself. Gross margins this quarter have been close to around 14.9% compared to 15.6% in the first quarter itself. They have seen a revenue growth of 25% in the Dmart Ready business. These are the implied numbers. But out here as well, because they are investing in it, the EBITDA loss has been around 11 crores versus an EBITDA gain of close to around 3.2 crores in the same quarter gone by. The other internal same-store sales growth came in at around 5.5%. This is the like-for-like growth for stores which are more than 2 years old. This compares with 9.1% quarter-on-quarter itself. And add to that, if you just take a look at what the brokerages have been saying, Morgan Stanley, for instance, they've cut their target price, and they're also, worried about the 20% growth algorithm that they had, with further room for downgrading for, the stock. If you look at all the others as well, Goldman Sachs, for instance, has a 4,000 rupee target price. They're saying that on the one hand, quick commerce competition continues, and on the other, the expansion for quick commerce players also is likely to continue as well, and that will weigh in on further competitive intensity coming in, not just in the metros, but beyond metros as well. So those are a bunch of factors which we're looking at. But I think the most important thing to look at, if you look at the shareholding pattern of DMart, 75% is held by the promoters. The institutions hold about another 17%, with, the CEO holding about 2%. So that leaves, in effect, no more than 5 or 6% free float equity in the market. So the impact cost of selling is a lot higher, and as a result of which the stock down almost 8.5%.
Absolutely, got that. And it's not just today's 8.5%, Mangalam, right? Look at DMart over this year or the last 12 months. In a year, I'm talking calendar year 2024, when the Nifty is up 15%, and if you look at the Nifty next 50, the larger sort of beyond 50 stocks as well, that index is up 40%. The mid-cap index has had a very good year. DMart has, absolutely done nothing throughout 2024. So the disappointment has been building for a while, and now the commentary coming in from the management obviously is just doing more damage. Mangalam, got that. Thanks very much. Let's actually take it up with our first guest on the show. Deepak Shenoy is joining in. He's founder of Capital Mind. Deepak, so for all the DMart believers who've been waiting patiently and thinking this is just one bad quarter, two bad quarters, this is just sounding really disappointing now. What do you think, and what would you advise here?
So we don't own a position yet. I think one of the things that's happening is, DMart is a ridiculously expensive stock. It has been for, I think, 4 or 5 years. 100 plus price to earnings. Yes, it earns 8% EBITDA margins and 5% PAT margins, which is one of the highest, and that's because they own their stores. But given that real estate is not really that maximum level constraint today in the economy, and the fact that their competition is now the smaller stores, the dark stores that the Blinkits and the Instamarts have built in order to capture maybe one part of the enterprise, I think their advantages don't give them a meaningful business advantage. Of course, they still have the margins. It's not like they don't have the margins, but they're priced to perfection. So now when you have a result that is not at perfection, you're unfortunately you're going to face some kind of price pressure. I don't think this is, even this at 100 times earnings is meaningful for this company to be valued at. But the whole market is very richly valued right now. So at some level, we're seeing some sanity. Perhaps I wouldn't have expected that DMart would lead that charge, but markets have us. Yes, I can hear you.
Right. No, got that. Deepak, hi, good afternoon. Do you own BSE, by the way? BSE at the day's high, it's cooled off. I think the intraday should come up. Market cap was almost 68,000 crores. And the last Thursday, and by the way, we had discussed this on that YouTube live, at that point, of course, SEBI had just come out with the norms that said that each exchange will only be allowed one weekly option contract, and it was not clear what would they choose. Last Thursday, NSE said they're choosing Nifty, and that is essentially sparked hopes that you'll have a big one in terms of some market share shift to the Bombay Stock Exchange. So almost 20% now in the last 2 sessions, Friday, and of course, there's 7.5% today as well. I think FY24 profits were about 1,200 crores. We'll only know after November, when this is implemented, whether the market share shift will happen or not, because it's all new. We don't know how this works. But what's your sense, Deepak?
Yeah, I think, the market is kind of, we talked about it that time, and I said, maybe it makes sense for both of them to choose their flagships, and they have. They've chosen Nifty and Sensex as the weekly expiry indexes, which gives them one expiry per week each. So I think the feeling here is the market share will shift to BSE almost of 50%. But a lot of people come to the market to trade options intraday, because that's the money they have on that particular day. So they're not going to have more money to trade at the end of the at one day of the week. So if you say, oh, I was trading 5 days a week with 1 lakh rupees, I'm going to enter the 6th day, but if you give me only 1 day a week to trade, I will trade 5 lakh rupees. That's not how it works. They still have the same 1 lakh rupees to trade, and they're the gamblers who come to trade in the markets, and that's what's giving the maximum revenue to brokers and a lot of the other players. So the volumes are going to drop, and they're going to drop considerably from what it used to be. There is also another circular which is, talking about for perhaps a change in the way the settlement guarantee fund will be calculated. I think that has more negatives to BSE than to NSE, especially if the volumes kind of have changed in the last 1 year to favor the BSE. So there will be a higher contribution to the settlement guarantee fund from BSE, and that's a significant portion. Last year, I think it was 1 quarter's profits. So in that sense, there are two negatives there. We have BSE, but we've reduced our position quite substantially now. I think that we'll only know after November 20th this year when we see the volumes drop. I also believe that both exchanges will change their monthly expiries to one expiry last Thursday of the month, to have the core index expiries done on a weekly basis. So you might have BankX on BSE on the second week of every month, and then the mid-cap Nifty on the third week. So they'll all try and get 2 days a week instead of that 1 day a week that they have by stretching the monthly expiries. But I still don't know if that's going to create meaningful opportunities overall. I feel that overall volumes will come down for both exchanges. BSE may have a higher market share. I still think the risk on the volumes and therefore on the revenue is going to be on the downside.
Got it. All right, Deepak, got that with regard to BSE. But let's talk about another exchange. And shares of IEX, well, they are under pressure after fears of market coupling, which has been a major overhang on the stock, resurfaced yet again. Speaking to the media, the Power Secretary, Mr. Agarwal, said that the work on power coupling mechanism is under progress. Let's listen in to that bite.
What the status on the power coupling, sir? So
no, that's on.
That's on.
Yeah.
Okay, so the government is committed.
Committed.
Coupling is on. That's the problem. Let's get in Vivek to help us understand why is this the big risk to IEX. Vivek.
Well, that's right. Essentially what coupling means is that number one, price discovery process that currently happens at IEX will be happening at an aggregator, and most likely it will be Grid India, where currently testing is going on. But as of now, what we understand is that still there has not been any conclusion made as to whether coupling is essential or is it beneficial to the entire short-term power market. But let us assume that, given the fact that important comments have come in saying that coupling is on at this point of time, let us understand the impact that it will have on IEX in terms of earnings. What Elara says is that market coupling can lead to significant market share loss from 84% currently to close to 70% by FY27, and they see 19 to 20% cut in EPS estimates for FY27. Now, what is IIFL saying? IIFL saying, number one, this is negative for IEX. They also say that this particular move risks IEX dominant market share as far as the collective transactions itself is also concerned. The company has 50% market share in the day-ahead market as well as the right-to-match market, and they say that FY26 EPS could see cuts of close to 25%. Now, remember, IEX on the back of this is seeing significant selling pressure, and it continues to remain an overhang on the stock, given the fact that there is still not too much clarity as to, number one, whether coupling will be implemented and when it will be implemented.
Got it. All right, Vivek, thanks a lot for explaining that to us. Deepak, from one exchange to the other, IEX, this has been the risk for a very, very long time. I recall IEX being more than a 300 rupee stock. Then it crashed on all the way to around 130, and then it found some buyers. Investec, I think, was one of those companies that were quite bullish on the counter. But clearly, it's seen a big, big sell-off We have heard this with regard to the power ministry at least twice in the last 1 month, and 240 has become 195. Your view at these prices?
So we haven't actually bought into IEX for a while. I think earlier there was more, like the 130s and 140s had the opportunity. I haven't seen this. In fact, when you brought it up is when I started looking at the coupling argument. I think it was in February when there was more talk about it, and then I kind of fell off my radar. So I don't know how crazy it is. In general, I would say the idea of a power exchange getting valued extremely richly here is not meaningful, because while volumes will increase over a period of time, you can't scale those substantially more than maybe 15-20% even in good times. So once you reach a certain amount of scale, you'll always have a drop off. So the terminal valuations here are much lower, and therefore paying very large fees for an energy exchange business here, especially because there's a lot of other kind of bilateral and other deals happening. I don't know if that's the right approach. But there may be short-term opportunities. Again, I haven't seen the stock, so I am sorry, I don't have anything meaningful to comment over here from a fundamental perspective. But I think long-term, we should be careful about paying too much for energy exchanges specifically.
Okay, all right. Deepak, I just wanted to ask you about your view on these city gas distribution companies, IGL, MGL, Gujarat Gas, all of them are under some pressure. There are a couple of sales notes that suggest that maybe the APM allocation could reduce. If that's the case, then these companies will have to source it either from spot or non-APM, which will come at a higher price and dampen their margins. That could explain one of the reasons why IGL is now one of the top losers, down 3.5%. If this happens, then how big a risk is it, and how you're placed right now on the city gas distribution companies?
We have no exposure here, and unfortunately, I haven't had one for a while. They're monopolistic players that are at a risk of their monopoly going off eventually, because at some level they've been given some relief on the procurement front by, say, an APM or something like that, because they affect anything they change on their end user pricing affects inflation to the common man. So it's a political problem that had to be solved. But over time, India is going to evolve into a point where they'll be like, listen, you have to get more market-led, but first from a procurement perspective, you'll actually go out of APM wherever there is too much pressure. So at some level, they'll have to hedge in the market. They'll have to build their own financial resources to counter price volatility. And on the other end, they won't be allowed to increase their end user prices meaningfully, because there is political pressures to not do so, because they're also publicly owned, as in public sector owned. So I see too many risks here to long-term ownership, even though the idea of gas distribution in cities and even in places like Bangalore, I think is going to increase quite substantially. They just end up having the same problem as perhaps companies like BPCL, HPCL and all that have, which is you have a great market, you have almost great usage, but you can't change your end user prices, and your procurement keeps changing according to the market, and you don't get great visibility. While we have some ownership in oil marketing companies, I don't have any in distribution companies yet. I think I'd rather buy them ridiculously cheap when there may be a short-term opportunity than to build a long-term story around them.
Deepak, what about Tata Chemicals? Rallied hard last week, and today it's coming under pressure, down 7%. There's still some back and forth about whether we'll have the listings of Tata Sons, which could be beneficial for Tata Chemicals. Where do you stand on Tata Chem, and what's happening in the counter?
So I haven't seen Tata Chem since, I think in fact, I feel really bad because I haven't seen many of these stocks. It's so difficult to track so many at the time. But on a specific note of Tata Sons, I don't think Tata Sons will ever list. They will do whatever it takes to not list. And they've already demonstrated that they've taken steps to ensure that they don't list. I don't know who's going to come in and, kind of take over the reins. But if there is one thing that I think has been common is if Tata Sons needed to be listed, it would have been listed by now. It's part of the oldest, probably one of the oldest family-run businesses in India, and they have a bunch of listed companies. So if they wanted to list Tata Sons, it would be listed by now. The RBI rules will not come in the way, and they have already made enough efforts to kind of counter that. So that's not going to happen meaningfully. What Tata Sons may do what it had done for Tata Chemicals was to unwind the cross ownership between Tata Global and Tata Chemicals, which gave a fairly large amount of cash to Tata Chemicals at the time. I don't think that's going to happen again. So though Tata Chemicals does own a bunch of other shares, that kind of unwinding might result in some cash coming to it. I haven't seen specifically a Tata Chemicals operation, but they're not specialty chemicals. They're more, commodity-ish kind of chemicals. The one thing they had in their favor was Tata Salt, which no longer is there. So to that extent, I'm not interested in that stock meaningfully anymore. If something's happened in the last few days, I don't know. So I haven't checked it out. So not really in my radar on a fundamental opportunity basis.
Okay, so not looking at Tata Chemicals, got that. Deepak, as we say goodbye, maybe a quick 30-seconder on Reliance as well. Obviously, we'll talk in more detail once the numbers are out. But I was looking at the stock. It's interesting. As the market has cooled off, Reliance has lost actually a little more than the index also. It's down about 7% this month. It's down about 15% from its peak, very quietly. It's a gentle, grind down, taking the stock back to about 2,700. What are your expectations? Not just today, but over the next couple of months. Where do you place Reliance in the larger scheme of things?
So honestly, Surabhi, I think here's where we own it. We own it. It's one of our largest positions. I think from a perspective of what they've done, moved away from a oil and gas giant in a way to a telecom giant and a retail giant. They're all going to get affected a little bit by retail from the issue that they had with Dmart which is with the e-commerce players coming and taking some of their market share. Jio, they're going to see an upward move because their realizations, because of the price increases, would have started to come into play more meaningfully. I also feel that some of their other initiatives have started to become profitable. They own a bunch of shares in Just Dial. They own a bunch of shares in a bunch of other companies. There is some consolidation happening on that front. They've managed to bring a lot of groups to at least some level of not making too much losses and some layer of profitability as well. So I think overall, this is a period of stability. What we are looking forward to is a point at which they will demerge the large arms, maybe 2 or 3 big demergers that should come. And that is going to be the trigger point, according to me, for Reliance. So I'm still a buyer. I'd continue to be a buyer, and as long as the sum of the parts, as I see it, is much greater than the whole. It's a much larger business than any one of their businesses. And therefore, it is, I think, when they independently list those businesses, whether it's a telecom and, a Geo arm, or whether it's the retail arm and so on, there will be a much greater valuation to the 3 companies separately added up than to Reliance is being given right now. So, I think long-term, the future is good, but this demerger and all of that stuff will take time. So it's going to test your patience, at least for a while.
Oh, yes. And when it happens, we are very sure it's going to be one of those, marathon, many hours of TV programming kind of events, right? Because I think this is the trigger that the market's really waiting for. We thought it will happen in the AGM, but there was no wind of it. I mean, who's to say?
No, I think
when it'll come through.
What Deepak said last week, Geo listing. I mean, that's the big one. And I think so. And of course, there is the other one. Of course, is the new energy business, which Reliance is building out very quietly, but very, very large scale. But that again, over the next couple of years, we'll start to see numbers start to come in. Deepak, thank you very much for that. Appreciate your time here. We come back with Ronak Omkar of PPFAS Mutual Fund. So he'll be with us on markets in just a bit. Stay with us. Okay, welcome back. We've got the market, which is up 160 points, very, very steady. And broader markets, of course, has been pointing out, has picked up as well. Ronak Onkar is with us, co-equity fund manager and head of research at PPFAS Mutual Fund. Ronak, great to have you with us here. Prashant this side. So just two questions to kick off this conversation. One, how much cash are you holding? Are you relative to what's usual for PPFAS? And second, the biggest ever IPO kicking off tomorrow. So without commenting on buy or sell or whatever, just your broad thoughts, because I'm sure you've looked at the company closely. Go on.
Hi Prashant, thanks for inviting me. So for the cash question, it is fairly obvious now. We have been increasing our cash levels over a period of time. We are close to 18% now, 18.5% as of the September ending month. So cash has increased because we have had a little bit of selling, and incrementally we have not bought new ideas to the same level as we have gotten inflows or what we have sold. With the largest ever IPO, again with IPOs it's very tricky to comment, but we have not generally participated in IPOs where the valuation demanded is too high or the sector is generally in too much of a fancy right now. We wait it out. If the valuations are reasonable, we do participate occasionally, but IPOs are not something where we study it as a business, but we don't generally study for participation.
18% cash level. I saw that, Ronak, when I was going through your latest fact sheet. I was like, wow, because I remember our last conversation, you were at around 16%. Now that's gone up to 18%, right? But the market has, cooled off a little bit at least. I mean, from 26,200, we are a good 1,000 points lower. You're still not finding bargains out there?
Not really bargains. Although the market has cooled off, some stocks have cooled off, but they have also risen quite sharply over the last year or so. So we are looking at a significant gain and just a little bit of drop from that peak. And that doesn't meaningfully change what happens in the business. So the reason why we don't buy something is because the valuations look impossibly justifiable from the business case point of view. The business might grow at its normal stage, but if people are expecting a lot more from that business, it's very hard to justify that kind of valuation. And hence, a little bit of drop doesn't really affect our choice.
Ask the question in a different way. What is it that you want to buy? I know you can't answer this question by naming stocks, but in general, themes, ideas, pockets that you're looking at that you want to buy, and you're just waiting for the valuations where you think they'll probably come in your comfort zone. Maybe they're at 3, 4, 5% off, not too long off. So what's close on your radar then on the buy list?
So we have a large grocery list of companies where we know that these companies have a demonstrated track record of operations over the last several years. And the companies are run by good managements. The companies have good business prospects. But unfortunately, when all these things are known and the market also agrees to these points, the valuations go away. I don't want to mention sectors offhand, but take a look at the companies that we have owned in the past and we haven't been able to buy more. That can give an indication of what are the interesting companies we would like to own. But at the same time, we are also buying companies which are still reasonably priced, still have same long-term prospects and run by capable managements. Those are private sector banks. Some of them are even the power sector companies we own, the PSUs in the portfolio. So it's not like we are always wanting to buy something just because we want to participate in the opportunity. It really has to meet all the parameters of management quality, business quality, and in the end, the price that we can pay.
Okay, all right. Hi, Ronak. Good afternoon and good to see you. And I want to ask you about these capital market plays, CDSL and MCX. If I'm not mistaken, I think they have already been multi-baggers from you. I think the returns you have got is 3 to around 3x or more. You could clarify on that point. But I can see you're steadily reducing and booking some profit in these positions. CDSL, MCX as well. I think there has been some kind of selling as well in Motilal Oswal. So particularly on CDSL as well as MCX, tell us what's the rationale out here?
So Nigel, to give a context on these capital market entities, these are actually very cyclical businesses. And when the cycles are doing very well, the earnings and cash flows of these companies disproportionately grow compared to their long-term averages. So at this point in time, they might look attractive from a absolute multiple earnings multiple or cash flow multiple point of view, but they're actually at a cyclical high in terms of what they can earn. Now, if you want to continue to buy them and scale the positions over a period of time, you really have to believe that a cycle can continue for a long period of time, which at the stretch valuations today, it looks unlikely, or the probability is very less for that to happen. And hence, it's good to become cautious about these capital market companies when the cycle is very high and the profits are at peak and the margins are at peak. So we can also scale down our expectations and maybe reduce the positions for now.
Okay, all right. So, Ronak, in both these two, you'll have reduced positions. I mean, in comparison to the initial quantity, more than half is gone, or close to half of the positions you'll have booked out?
Over a period of time, we have been gradually selling.
Okay.
So on an absolute basis, you'll have to check time to time how much quantity we have in the portfolio disclosure.
All right. So MCX and CDSL, some profit taking out there because, some of these businesses maybe they're having a good run as of now, but you all prefer to take some money off. The other point I want to ask you is on PSUs. Everyone's debating about actually whether the PSU rally has paused or the PSU rally is over. Now I'm looking at y'all have switched things around. NMDC, y'all got in early, y'all played that special situation, y'all are booking profit over there. While on a couple of other names like Power Grid and Coal India, y'all are adding positions over there. So what's your approach to the PSUs and what do you all like what are you all booking out in?
So we don't look at them as a PSU category. We look at them even from sectoral category. So of course we know that the owner or the promoter is the same for all these companies and the outlook towards these companies is the same. But individually these companies are quite different. And if you look at some of the power sector companies we own like Power Grid or Coal India, there really is no short-term option for these companies in the market right now in terms of what they offer. One is coal availability for thermal power generation. At the same time, transmission capacity and management of the grid from the power grid point of view. So these two companies are steady cash flow generating businesses. They keep paying out large chunks of dividend and their capital outlays are known for a long term because they have to announce based on what the ministries plan for these companies. Whereas companies like NMDC are more like cyclical companies, although PSUs as well. But their earnings are dependent more on the price of iron ore and the demand for steel in the global markets. So they are not like to like comparable just because they're owned by the same promoter, but they are different sectors and have different dynamics to them.
Parag, what about stocks like Trent, Zomato? These are consumer plays. They've been fantastic performers. They're absent, at least they don't show up in the top holdings for most of your funds. Do you own them? And what would your view be on stocks like Trent or even a Zomato?
So we don't own them. We study them very closely because they are actually at the forefront of some of the most interesting trends in consumer retail segment today. Whereas Zomato does food delivery and Blinkit at the same time, Trent has done a good job with Zudio and scaling number of stores. I think from category leaders point of view, we study them and we understand them, but we have not bought them because the criteria for us to purchase any business is, first of all, having a good quality business in the beginning, which retail is very hard to consistently become a good quality unless you have some strategic moat around your business. Second is these companies have a very short history of performance in the market today in terms of cash flow generation or growth. We generally want to have a long history of operations and then probably in the future, if the business model continues to be strong, then we might buy at a reasonable price. So we studied them very closely compared to other peers in the market, but we haven't bought them yet.
Okay. You spoke about how you've trimmed profits in CDSL, MCX. Last time you told us that you trimmed your position in IEX, Oracle Financial Services, even NMDC. Any more stocks that you have done some profit booking or trimmed your holding?
So IEX we haven't trimmed, but the ones you mentioned, the capital market entities, we have trimmed a little bit. So those are the ones. The reasoning I have mentioned earlier that some of them are at cyclical highs and the network effects are good for these companies. But if at a cyclical high, you really have the cycle to continue at a much broader swing in order to provide the same operating leverage going ahead. So we don't know whether the cycle will continue at the same momentum. So it's better to be cautious at this point.
Okay, all right. Ronak, we'll leave it there. Good speaking with you. And will the next time we speak, will the cash be north of 20 or what?
I don't know. I don't want to predict such things, but let's hope so that we get good chances to deploy opportunities.
No, absolutely. Just kidding with you. Thank you for joining us and good luck to you and your team. You guys have been to, of course, run a wonderful fund for your investors. Now, Reliance, of course, is the big one in terms of earnings today. What should we expect? Numbers should be out later this evening. Sonal is here with a snapshot view of what the preview looks like. Sonal, over to you.
Thank you so much for that. Well, the stock is flat today. It has been, it has seen a return of around 7% this year so far, and the stock trades at 22 times FY26 EPS. Now, in terms of the consolidated numbers, let's look at that first on a YY basis, which is expected to be a decline this time. Revenue is expected to decline by 8%. The EBITDA is expected to decline by 12%. Margins should see a decline of around 500 basis points, and profit should be down 21%. YY it's expected to decline because the O2C segment will continue to see pressure. This is something that we've seen across the industry. But if we look on a quarter-on-quarter basis, there will be an improvement. The revenues, they'll be flat, but EBITDA is expected to increase by 2%, margins will see an improvement, and profits are expected to see a growth of around 4% to come in at 15,738 crore rupees. That's the profit number that we are looking at. Now, what are we watching out for? In terms of an improvement in quarter-on-quarter basis, a weakness will be seen in the retail and O2C business, but it will be supported by the Jio business, and that is something which will support businesses and the numbers this time around, which will see a benefit from the tariff hikes. Singapore GRMs, remember, they have been under pressure. This is something that we've been seeing across the industry, and they have settled at $3.6 per barrel. So Jeffrey says Jio's EBITDA should see a rise of 9% on a sequential basis on flat subscribers, but 7% rise in average revenue per user. Retail EBITDA should rise 5% on a sequential basis, but O2C EBITDA is the one which will see a degrowth of around 1% on the back of lower petchem spreads and refining spreads as well. So watching out for what the management commentary here is. So Jio will support the numbers this time around. However, we'll see some pressure coming in from O2C this time.
Indeed, 20% was the tariff hike that Reliance Jio undertook on 3rd of July. So full quarter benefit of that tariff hike to support Reliance Jio's numbers this time around. According to our poll, 7% revenue growth quarter on quarter and about 12-13% at the bottom line. Get into a break. On the other side, we'll get you a few BTST calls from our technical experts. Stay tuned.
Welcome back. Well, we're holding about the 25,100 mark. Nifty Bank, the star in today's trading session. Mitesh Thakkar is back with us. Mitesh, if someone had a long position on the Nifty Bank, would you advise them to carry that position into tomorrow's session? Because last few sessions we tested these levels, but we couldn't close out there. Today it appears we're going to close out there. So carry it or close out the position. Also fill us in with your fresh calls.
No, I think Nigel very clearly carried this, and the trailing stop loss, as I said, should be closer to 51,650 in this spot, which is roughly about 145, 150 points lower from here. That about Tech Mahindra is something which is of interest to me, closing near the day's high. That's a BTST with the stop below levels of 1679 for target of 1720. And Wipro, I think the stock has done well, just mildly off the day's high, but the structure is quite good here. So take a BTST with the stop at 545 for targets of 558.
Thank you very much for that. Let's get to MTNL. The MTNL stock price is up 5% today, and sources tell CNBC-TV18 that MTNL will not be allowed to shut shop. Sapna joins in with the details. Sapna.
That's right. The indications within the government circles is the fact that MTNL should continue as a going concern. This is what the buzz is within the government circles. And, heading towards NCLT is not the best option. It may not set a good precedent for the other PSUs. So keeping all of this in mind, it's likely that some kind of a revival / rescue package could be in the works. Now, we are aware of the fact that there is a committee of secretaries which has been looking at the MTNL issue in great detail. No lifeline as such has been worked out yet for the beleaguered telecom player. However, the way things are with this kind of messaging that not going to NCLT, not shutting shop, that will not set a good precedent for the other PSUs. Maybe a revival package may be in the works. So all of this very clearly indicates that the government will try and keep MTNL as a going concern. Having said that, a couple of issues that need to be sorted out very quickly. One is that, maybe in the long run, somewhere around 7,000 to 8,000 crores is the kind of infusion that may be required, but that's more long term. As of now, the concern is how to get the company back on its feet and what is to be done about the accounts which have been declared NPA. So I think something on those lines may be in the works, but we'll have to wait and watch and see what is it that the government finally decides, short term and long term.
Thank you very much for that. Sudeep Bandopadhyay, Group Chairman of IndiTrade Capital, is now with us. Sudeep, the top two movers on the way down, one of them is IEX and the other one is Avenue Supermarts. Did you hold any of these stocks? Was it a part of your recommendations ever? And what does one do with these stocks if they own it?
Well, as far as IEX is concerned, it's a little, confusing situation with the market coupling becoming a reality in the near future. And there are multiple views on how it will impact IEX. It's too fluid a situation. So I definitely don't recommend anybody buying into IEX at this stage. If somebody is already invested in IEX, maybe they can wait and watch how things unfold. My personal belief, understanding whatever little we could from the commentary which is coming out, is that in the long run, it may probably even out for even IEX, the market coupling issue. But in the short run, there will be some impact. So if you are a long-term investor already in IEX, maybe you remain invested. Otherwise, it's better not to enter definitely at this stage. As far as Dmart is concerned, I think, company has done excellent performance over the many years. But as things stand today, there are a lot of things happening, a lot of moving parts, as one would like to say. The quick commerce has become a big business, and that is disrupting some of these big box retailers as well as kirana shops. And one has to see how the online delivery picks up as far as Dmart is concerned. The store expansion, how it keeps, and how the margin profile remains going forward. There is, of course, a distinct difference between the tier 1 towns and tier 3, tier 4 locations where quick commerce is not big, and it may take a long time before it really becomes big. So Dmart still has a long way to go before it reaches its true potential. But as things stand today, there is definitely a pressure on Dmart, and it's not a very clean runway like it was, let's say, about a year back.
Okay. By the way, there are lots of interesting names in the broader market today that are moving. One such name is Brainbees Solution, first cry, 5.5% up on this stock. We've of course discussed some of the capital market plays like BSE and CDSL, so those are big movers as well. Look at Raymond, 5% up on Raymond, 7.5% up on Bombay Dyeing. Not a very usual name coming up on the screen, but there's interesting price action around it. Then the shoemaker Red Tape up about 7% as well. VA Tech Wabag about 8%. So yeah, there's a lot of interesting churn going on in the broader market, and several new names coming out on top at the surface. Sudeep, hi, good afternoon, good to have you on. You know, earlier in the show, I was talking about this JP Morgan note on L&T. Today, they came out with a note and they're quite positive on the counter. I think they've initiated coverage with a price target of close to, I think, 4,300, if I'm not mistaken. And they expect a very steady run rate for both the EPS growth, revenue growth, and they're expecting margin improvement in the coming months. Do you share that optimism on L&T?
As will be definitely. I mean, I've been positive on L&T for last 1 year. Somehow the stock hasn't done anything great, but the performance on ground, as far as the business is concerned, I think it's improving from all the angles. Look at the order book now. 1/3 plus order book is international. The margin profile is continuously improving. They have got out of a lot of unrelated assets. The working capital situation has significantly improved. There is a huge tailwind behind their construction infrastructure business. The hydrocarbon business has picked up in a big way in West Asia. The subsidiaries, particularly the IT subsidiaries, are doing very well. And the expectation is that, with the scenario improving in US, they will continue to do even better in the near future. So I think it's a confluence of positive factors, which is around L&T now. And I won't be surprised if they cross 4,000 in the short to medium term.
Okay. All right, Sudeep, stay on. We'll come back to you for some more questions. Right now, a quick break, and then we'll be in the last leg of today's market action. Back in just a moment.
Welcome back. Well, a few minutes to go before we wind down, and a few stocks actually could make their way into the F&O ban list. They include IEX, Nalco, as well as Tata Chemicals. So by the end of today, we'll get that list. Let's see whether or not all these three, as of now, it appears that they'll move into the ban list. But Sudeep's still with us. Sudeep, we're getting into election year in Maharashtra, and sometimes you see some kind of a booster shot announced for real estate companies. You have a select number of names. Oberoi Realty has been moving well. Which Mumbai-based real estate company is best placed according to you?
Well, I think I'm not sure about the boost before elections, but yes, real estate is a sector which we've been liking for some time. And we believe that we will see, again, momentum coming back with interest rates in the economy coming down. RBI hasn't done anything in last policy, but I think December onwards, there will be pressure on RBI to cut, subject to inflation coming under control in the near future. So when interest rate starts coming down, there will be definitely pick up in low cost and medium range housing demand. All this while we have seen the high end houses properties moving, but we will now probably start seeing the lower end of the housing spectrum moving with interest rates coming down, and that would be a boon to many of these real estate developers. It may not be Oberoi, it may not be Macrotech, but some of the other smaller players may benefit in a big way. I would also look at Godrej Properties very minutely. I think they have the potential to deliver even from current levels.
HCL Tech will also be reporting numbers, and ahead of that, the stock is closing with a gain of 1% and at its lifetime high levels, closer to 1860. Now, in terms of Q2, remember in Q1, revenues for the company declined. So this quarter, there will be growth, but growth will be tepid because of about an 80-90 basis points impact due to insourcing at the State Street JV, basically because of one issue. And therefore, revenue growth is seen at just about 0.6%, but margins are likely to expand by 100 basis points, and we expect the company to hold on to its full-year revenue and margin guidance. The stock is going in fairly upbeat, 1% higher on HCL Tech. Sudeep, quick word on lots of big IT earnings this week. We've got HCL Tech, Wipro, Infosys, LTIMindtree, Mphasis, the entire list. Which one would you pick for Q2?
Well, I think, BFSI is one segment which is definitely really getting excited as far as US is concerned. And some of the companies which have a significant exposure in BFSI will be interesting ones to look. So Mphasis with about 60% plus exposure with BFSI will definitely be watched carefully. I also would be looking at Infosys carefully, while the financial services exposure is within a certain range. But I think Infosys relatively does look attractive even at current levels. I will definitely watch the numbers as well as their commentary.
Okay, Sudeep, stay with us. We're just going to wrap up things here because there's a minute to go to market close. 25, 140, 176 points higher. So this is definitely a good day. And by the way, the opening was at about 25,020. So this is, almost all of the gains coming through slowly and steadily through the course of the day for the market. So nothing happened till about 9:45-10. There was a big move after that, sell-off. No big decisive move, but a slow and steady move higher is what we've seen. I'll just look at sectorally speaking what did well. Real estate, of course, stood out. The top moving sector, 1.6% higher. IT index was up 1.5%. And you had the Nifty Bank, which was up about 1 1/3, largely thank you to private banks there. The Nifty Private Bank Index itself about 1 1/4% in the green. Rima.
Okay, let's get to the individual stock movers in the large cap space. Wipro sees buying ahead of the bonus issue announcement and numbers on Thursday. Stock was the top gainer. Tech Mahindra looking good, up nearly 3%. HDFC Bank provided company. L&T, where there was an upbeat note with a target price, I think, at 4,700 to 4,800. L&T also soared nearly 2%. Giving it company on the way up was ITC, more than 1.5% higher. On the way down, ONGC, Maruti, Tata Steel corrected a bit after last week's gain. Bajaj Finance too under pressure. Mid-caps, which were floundering in the first half of the trading session. In the second half, the mid-cap index managed to close up with a gain of close about 0.5%, though the advance decline ratio was in favor of the advancing stocks. Avenue Supermart ends with a cut of about 8%. Big fall. IEX under pressure too. Bandhan Bank, Bajaj Housing Finance were some of the other casualties in today's trade. With that, it's a wrap and closing bell, but markets forward comes up next.